Hello and welcome to this Mirror Facebook Live, all about the Bank of England interest rate decision today and what that means for you and your money. I'm Sam Barker, a money reporter here at the Mirror, and I'm hugely grateful to be joined by the Mirror's head of business, Graham Hiscott. Hello, Graham.
Good morning, Sam. Good morning, everyone.
So we're going to be talking about everything that's happened with the base rate decision today and what it means for your personal finances. So that covers mortgages, savings, loans, and more. Whatever the Bank of England does with base rate, someone loses out. And that includes if the Bank of England does nothing at all. So we're going to be breaking all of this down for you today, including what to do if you're worried about rising costs and all the help available. But we're also here to answer your questions. So if you have anything to ask or you just want to have your opinion heard, feel free to post in the chat. We'll do our level best to respond both during this session and if we run out of time afterwards as well. So let's start by explaining what has happened today. So the Bank of England has just put base rate up from 1% to 1.25%. So what does that mean? Base rate, which is also called bank rate or the interest rate, is just a tool that the Bank of England uses to control the economy. And for years, this hasn't really been in the headlines because it hasn't really changed. The base rate stayed at 1% or below since February 2009. Then in December of 2021, the base rate started to rise. It started to rise very slowly from 0.10% up to 0.25%. What that led to was a stream of increases to the base rate. And that means knock-on effects to you and your money, because the base rate, it's now getting to the point where it is high enough to start having a real impact on all of us. And you may well have already started to see this. So Graham, do you mind talking us through, why have the Bank of England made this decision today?
Yeah, good afternoon. Hi. The Bank of England's first job, the main job, its biggest task is to try and keep inflation under control. Now, it has a target. It's 2%. That's what it. Ideally, that's when it's happy. That's when it can sleep at night. It's certainly having a lot of sleepless nights at the moment. Inflation, using this measure called the Consumer Price Index, it's at 9%. That's at a 40-year high. It thinks that already thought it might get to about 10% in October. And actually, in its update today, it now thinks it might get to 11%. So 11% is what it thinks the annual rate of inflation might get to. Its target is 2%. How can it try and bring that 11% or that 9% as it is now down? One tool, its main tool really, is increasing, as you say, the base rate, which influences interest rates. Now, the theory of that is that as our borrowing costs go up, it deters us from spending more money on other things. We might, if it's more expensive for our mortgage, then we're theoretically going to not buy that new sofa or the TV or something like that. But it's a controversial thing to do because a lot of the inflation is coming from what's called external forces. So the reason why your energy bill is going up is factors way outside of the UK's control, things like global oil prices and stuff like that. But nevertheless, it's doing what it thinks it can do to try and bring down inflation in that way by increasing borrowing costs. But also, the other key thing is to try and manage expectations. So it's hoping we all think that inflation going to give us an idea about what inflation might be in, let's say, a year or even 18 months' time. So it's all about getting us to think further ahead in terms of what our outgoings might be.
Thank you. And if anyone's sort of tuning in and thinking, well, inflation, 9%, 11%, what does this mean for me? I mean, basically, the simplest way of kind of looking at this is that if something costs £1 today and inflation stays at 9% for a year, that same item in a year's time would cost £1.09. So it's quite staggering how quickly inflation is going up. It's a bit of a rough figure because it covers an awful lot of goods and services. But if you add it all up and then divide, that's the figure that we've got, and that really we're feeling the pinch of that in the cost of living crisis. As Graham says, an awful lot of this is energy bills, but you will have noticed it perhaps if when you're shopping, the cost of kind of groceries is all part of this. And particular items have been, within supermarkets have really been soaring up so quickly that they're kind of dragging this inflation level up. So the Bank of England, they've put the base rate up ever so slightly today. And this, as we mentioned, it has got a knock-on impact on loads of areas of personal finances, and this includes mortgages. So Graham, if you're a homeowner, what does this base rate rise mean for you?
Okay, well, first and foremost, actually, for the majority of mortgage borrowers, it doesn't actually mean anything, because the vast majority, something like 8 out of 10 mortgage borrowers, are on things called fixed rate deals, which, as the sort of name suggests, is that, the rate that you pay is fixed for a certain period. So normally when you take them out, it's normally 2, 5, or in some cases longer, 10 years perhaps. So actually you'll be looking at this and you shouldn't necessarily be worried, certainly when it comes to your mortgage. However, there are about 2 million borrowers who are affected in one way or another. They might have like a tracker mortgage, which is linked to the base rate, or it may be that they're on a standard variable rate mortgage, which is normally a rate that you tend to go on if you're not with the lenders, on any product with the lender, any sort of special product, fixed rate deal, etc. So there are a lot of people who are affected in their mortgage rates. Now, how much it goes up? Well, that really depends on which mortgage borrower, which lender you're with, and obviously what rate you're paying. Now, there's been a lot of numbers flying around today in terms of what it could mean. But as an example, if you're on a standard variable rate and you've got a £150,000 mortgage, you could be looking at something like 20 quid a month, maybe sort of the order of £250 a year increase in your repayments. But that's on top of, Sam, as you said earlier on, those other 4 increases we've had so far. So the cumulative effect of that, again, it depends on your own circumstances. But I've seen one estimation this morning, one calculation that some mortgage borrowers have seen their repayments go up by something like £1,700 a year. But as I say, the majority of mortgage borrowers won't be affected now, although, Sam, we might want to talk about those that might be affected if they're on a fixed rate deal and their deal is coming to that special rate is coming to an end, and that is happening all the time. So hundreds of thousands of people are every month are noticing, the impact of this, and we'll see a pretty hefty bill shock when they come to get a new mortgage.
Yeah, I mean, absolutely that. I mean, basically, what we're going to face if you're a UK homeowner, people in this country with mortgages, we love shopping around and we love short deals. So in an awful lot of the world, this is common in America and across a large amount of Europe. If you get a mortgage, you're probably going to be paying the same rate maybe for 20, 30 years. The idea that you would swap, you would shop around with a 2-year deal or a 5-year deal is quite rare across a lot of the world, but it's the way it works in Britain. So the issue is that obviously in this country there are an awful lot of people on fixed rate deals who are kind of renewing at a high rate. So what that's going to mean is if you perhaps fixed your mortgage 2 years ago, you might be, because the base rate was so low, your mortgage rate probably reflected that, and you probably weren't paying an awful lot more, maybe 1-2%. But a lot of people, they're going to be coming towards the end of their mortgage and they're going to be faced with basically higher rates. I think the cheapest 2-year fixed rate that we saw earlier this week was something in the region of 2.4, 2.5%. So a lot of people will be paying more, but there is some good news, which is that depending on the terms of your mortgage, you can lock in a new rate up to 6 months before your current one ends. So some mortgage lenders won't let you do this. The overwhelming majority will, and it tends to be up to 6 months before your current one ends. And the reason that this is an important thing to think about is because base rate, I mean, no one's got a crystal ball, but base rate is very, very likely to go up further during the course of this year. So the mortgage rates which are available now, again, there's no real telling the future, but the mortgage rates that are available now are quite likely to be an awful lot better than the mortgage rates which are going to be available in a month, 2 months' time, particularly because this base rate rise today, it will take lenders from a few days to several weeks or even several months to price that into their new mortgages. So if the message here is that if you are a homeowner, you're coming towards the end of your mortgage term, perhaps over the next sort of 6 months or slightly longer, talk to lenders directly, talk to mortgage brokers and say, am I better off fixing a sort of a rate now? So you will probably be paying more than you were, but you will be paying less than you would have if you get towards the end of your term and then you start to shop around. So, and this is, we're just talking about mortgages, but, the base rate rise, it does affect other areas of personal finance as well. And one of those areas is loans. So personal loans, because the base rate rise is factored into the interest that lenders charge. So Graham, similarly to mortgages, if you are a loan customer and you're quite worried about base rate rising, what does it mean to you? Is this rise going to be passed on straight away, or is there a lag?
Well, there tends to be a slight more of a lag when it comes to other products, but also you've got to also remember that it depends on the product you've got. So again, if you've got a personal loan, there is a good chance that it might be fixed again. So again, be aware of that. But if you're taking out a new personal loan, for instance, yeah, I mean, I think I saw a stat the other day that personal loan rates are about a 7-year high. So it's getting more expensive to borrow money, and it will feed through into overdraft rates and other things like that. But when it comes to credit cards, for instance, Sam, I'm sure you see this because you do this all the time. There are still some really good 0% purchase cards out there, so and 0% transfer deals. So there are some good deals to be had if you are needing to borrow money. But again, wanting, these are all really difficult things because some people, whenever we look at borrowing, we tend to think it tends to be because people want to go out and buy that new thing, that new car, or that whatever. But increasingly, we're seeing people borrowing just to pay their essential bills, which is extremely worrying. And if those borrowing costs are going up for instance, a credit card or a personal loan, then it's just going to compound the difficulties that many people are experiencing, and hence why quite a few commentators are describing this increase today as a hammer blow to those who are going through real tough times at the moment. It's certainly going to be very bad news for them.
I think it might be, and I think there are an awful lot of people in society where the cost of living has gone up. They're paying an awful lot more than they were. Inflation is also very high, so any kind of increase to the base rate, is a bit of a cold comfort, because obviously the Bank of England is doing it to bring inflation down. But there's an awful lot of people who say, well, that's great, but because you're putting base rate up in the short term, what's going to happen is that I'm going to be paying more money. But I'm not going to see the benefit of you doing this for several months. So what you're really doing is turning the screw on me. But obviously, they've got a huge problem to crack, which is soaring inflation. And there were some members of the Bank of England who wanted to put the base rate up even higher than it was, up to 1.5%. And if we look across that, yeah, that's right. So it's actually a quite high by kind of Bank of England standards. In America, they're dealing with a similar problem, and they've got a similar system to us in terms of they've got a kind of effectively a base rate, and that went up by I believe 0.75%. Was the news this morning. So obviously they're far less cautious than this country has been. So we've spoken about mortgages, we've spoken about loans. Now, there is a slight silver lining to all this. So, Graham, if you're lucky enough to be a saver, have money in savings, perhaps be shopping around for savings deals, it's slightly better news for you today. And why is that, please?
Yeah, indeed. And I mean, savers have been the sort of forgotten victims of this record low interest rates for over a decade now. And it'd be great actually to hear from any savers in the comments today, because it'd be great to hear your feedback. Yeah, I mean, look, the logic is that when the base rate goes up, generous banks pass it on to savers, so they get a little bit more money they get more interest for the money that they're squirreling away with them. Don't expect it. This is the problem. Is that those banks have got are so awash with deposits, they're so awash with money, that they don't kind of need your money that much. So there's not the incentive for them to give you eye-catching interest savings rates, good savings rates. So the fact is, almost all the best. I mean, you're very unlikely. You should be suspicious, perhaps even, of a savings rate that is anywhere near the rate of inflation. So that means, in real terms, you're seeing a real terms reduction in the value of your savings. They're going down. So yeah, theoretically, you're going to see banks begin to pass on this interest rate rise, but don't hold your breath. They don't have to. They probably won't. And the fact is, a lot of people have got their savings in rates that are paying pitiful amounts of interest. I mean, just pitiful amounts, because people aren't really shopping around and are keeping their money with the big guns, and they tend to not offer the best rates. So that's the logic, but in reality, your rate won't be going up. And the other thing is people are beginning to draw down those savings just to pay essential bills. So that's the other factor that's coming into play with savings that we didn't have perhaps 6 months, a year ago.
Thank you. And sort of having a quick scan, over the comments, we're getting a few comments along the lines of, this isn't, the Bank of England, these base rate rises are not high enough. Inflation is going to get worse. I mean, perhaps it's worth, sort of talk. We're pretty sure inflation will get worse. The Bank of England, as Graham said, kind of slightly earlier on this call, they had a target of 10% that inflation was going to hit. This year, they now think that will be 11%. They think a large part of that will be energy bills, which are likely to go up again in October. But if for anyone who's sort of tuning in and thinking, well, this is all great, what is the future for base rate? Graham, I appreciate you've not got a crystal ball in front of you in that meeting room, but if you were a betting man, do you think it's likely to keep going up?
I think it will continue to go up. I wonder whether this is perhaps whether there might be a pause on this, despite the fact that 3 of the 9 members of the Monetary Policy Committee voted for, as you said, a half a point increase. I think that there's a definitely a wait and see element to this in terms of because what they don't want to do is put up rates too much that it pushes the economy into a recession, and we've certainly seen a sharp slowdown. And if you push up borrowing costs too much, that means we all spend a lot less, and that means that we're a consumer-driven economy. So that could mean that it tips us into a downturn. Now, the Bank of England is not forecasting that, although it's previously said that it thinks the economy might go into reverse towards the end of this year, but whether it will be technical recession is up in the air. Now, so to answer your question, no crystal ball, but I think that rates will keep rising. I think it's debatable whether we'll have a 6th increase in succession. We just don't know at the moment. I mean, it's a balancing act, I think, at the moment. I think a lot depends on what happens. A lot depends on what's happening with wages as well. That's a really hot topic at the moment, how much wages are going up by. So the Bank of England, the MPC will be keeping a very, very close eye on what's happening with wage settlements.
Perfect. No, thank you, Graham. And just sort of turning very quickly to Tony. Roy, thank you for your question, Tony. Obviously, we're here to answer any questions you've got, so please do feel free to post them. Tony's saying, will credit card interest go up? So, I mean, the likely answer is that, yes, it will do. It's, what we certainly have seen is a huge increase in credit card borrowing. So the number of British people using credit cards and how much they're using. In fact, it's the highest rate for 17 years currently. And this is being driven, the Bank of England thinks, by the cost of living, the fact that things cost more and people need the money to sort of pay often for very basic expenses, and a lot of them are turning to credit. Now, what we haven't quite seen yet is a kind of a dramatic kind of increase in credit card interest rates. But I strongly say, and this is partly, as Graham says, because there are still an awful lot of kind of 0% deals out there. I think it's very hard to know exactly what's going to happen. My kind of gut feeling would be that it's very likely that some of those 0% deals are going to disappear. And that the kind of interest rates for credit card loans, for credit card borrowing will go up. However, there is something which is sort of perhaps going to act to kind of keep a lid on this, which is that the regulator, the money regulator, the FCA, sort of perhaps seeing this problem coming, has written to about 3,500 lenders, I believe this morning, it might have been last night, basically saying, you've got a lot of vulnerable customers, you've got a lot of customers in debt. We are concerned that some of your fees are higher than they should be, and that a lot of your customers are not being given the debt advice which we require you to give them. So what sometimes happens when financial regulator kind of fires these kind of warning shots is that the lenders do kind of hop to. So if you turn the clocks back to the financial crash of 2008 sort of 9 time, obviously it was a really tough time for a lot of people. There were a lot of people who mortgage lenders didn't take their houses, basically, even though they weren't making the repayments. And the reason was the financial regulator sent a similar letter to mortgage lenders saying, we're going to take a very, very dim view of you taking people's houses at a really, really difficult time. Please don't do it. So these letters, although it can seem a little bit kind of like, a little bit tame, that they're just sending a kind of a letter to chief executives, it can have a real impact. So that might help kind of keep any increases kind of low. Now, I appreciate we're kind of almost running out of time on this call. One thing that we get an awful lot of on the Mirror is people saying, I'm struggling for money. What are the options that are available to me? What is the help available to me? So I think it's worth, we've just spent quite a lot of time on this call talking about, costs going up. They're going to go up further. Inflation, is going to continue to kind of rise. The cost of living, certainly for the next few months, looks like it's going to continue to rise, as will energy bills. So it's just worth, I think what we'll do, we're just going to recap some of the options which are available for people who are struggling. So some of this is money that's coming from the government. So every household in the country, every energy bill payer will be getting a £400 grant. If you are on means tested benefits, you will be getting £650. That will be split into two chunks. There are a few exceptions to that, which we're going to come on to, where the timing is slightly different. There will also be, there's a £300 payment for pensioners and £150 for disabled people. So depending on which kind of camp you're in, you may be eligible for more than one of these pots of money. Now there is one means tested benefit. I mentioned that there is an exception. So if you're on housing benefit, but you don't get any other benefits, housing benefit is a means tested benefit. But as it stands, the latest from the government is that you probably won't be getting the £650 benefit that everybody else on means tested benefits gets. And obviously, for a lot of people will be saying, well, why is that? That is because, according to the Chancellor, Rishi Sunak, HMRC can only track down people to make these payments if you're claiming housing benefit and another benefit. Don't ask me why the system works that way, but that appears to be the case. So if you're claiming housing benefit and something else, you will get the 650. If you're only claiming housing benefit, the government's kind of got a catch-all solution for you, which is called the Household Support Fund. So this is another pot of money available for people who are families who are struggling, households who are in need. It's being doled out. It's government money. It's being paid out by local councils. So if you are in this position, maybe you're in some sort of financial need, or you're claiming housing benefit and no other benefit, speak to your local council, who will be able to direct you to the Household Support Fund. Now, the thing that is worth mentioning with this is that the way that each council, they've got a bit of flexibility in how they give this money out. So some councils give out the money as cash, and some households will give it out in the form of vouchers, for example. Do get in contact with us at the Mirror if you're having any kind of difficulty with this, because we did hear from someone this week who said that their council had told her that they'd run out of this money. Now, that is the first that we've heard of that. If anybody else is being told that, we'd be really interested to hear. There's £1.5 billion in this pot that the government's giving out. So it seems unlikely that the councils would start running out, but if that's happening to you, do get in contact. So the other thing to mention with some of this kind of government help for you is that if you're on tax credit, so child tax credit or working tax credit, you will have to wait longer to get your £650 government payment. So what would be happening for everybody else is that you would get your first payment in July and your second payment in what the government's calling the autumn. They haven't actually set a date for this. But if you're on these tax credits, then you will get your first payment in the autumn. Again, we don't quite know the date, and your second payment in the winter. So the reason for this is because the government want to save money and not pay people twice. So what's happening is tax credit is being phased out and replaced by universal credit, as an awful lot of benefits already have been. And so if you were to, for example, put in a claim now for tax credit, the government is worried that they might pay you twice. So once because you've got the tax credit, and then again once you flip over onto the universal credit system. So unfortunately for you, if you are on tax credits, what that's likely to mean is that you will get your money later than everybody else. Unfortunately, that just seems to be how the government's doing it, and there's not an awful lot that we can really do about that. So, I think we're almost coming, towards the end of our time today. It's been half an hour. I wanted to say, thank you so much, everybody, for tuning in. I hope you found this helpful. Thank you very much, Graham, also for your time today. So we will do these sessions every single Thursday at 1 p.m. We take a different aspect of the cost of living every single week. We kind of break it down and we try and take your questions. Anybody who we've not managed to get round to today, I'm sorry about that. We've had so many comments. I would encourage you, please email the following email address. So it's a bit wordy, so just be prepared. So it's mirror.money.saving@mirror.co.uk. That's mirror.money.saving@mirror.co.uk. We monitor, it popped up on the screen, and we'll do everything. You're really having trouble, please do let us know. We'll do our best to kind of help out, to kind of help you get the help you need.
Yeah, and also email us and get in touch if there's any subjects you want us to cover as well. So that'd be great to hear. So,
absolutely.
Yeah.
Right. Well, thank you very much again, Graham. Thank you so much, everybody, for tuning in. And you can catch us next Thursday at 1 p.m.
Thanks, everyone. Goodbye.
Thank you.